Hello, ladies and gentlemen. I am the ACCA tutor, Jerry Mutimukulu, from Transcairo Consulting Services. I specialize in teaching accounting and finance online. Okay, we have helped a lot of accounting professionals and students through our online learning media. Okay, in this particular video, we are going to tackle issues related to responsibility center approach. This is actually a recap to those who have been studying with us the ACCA management information paper. Okay, we have been studying this for the past 2 months. Okay, because our lectures, our ACCA modules are just as short as possible. Within 3 months to 4 months, you will have finished everything which is linked to a particular module. All right. So if you feel like you want to start with us, you can just get in touch with me anytime, 24/7 on this number. Okay, that's my number. This is my email. You can also get in touch with us at Transcairo Consulting Services on this email address, okay, at gmail.com, okay, or simply visit our website. As you can see here, that's our website, where we'll coach you, we'll groom you so that you pass your ACCA studies as soon as possible. You know what? There is actually a very huge advantage in having a certified tutor, okay, somebody who has been trained in that area. He has got all the knowledge which might actually assist you to pass your studies as soon as possible. So without wasting much of your time, let us just go straight to the business of the day. This last lecture, is centered on the concept of responsibility centers, and it looks at how costs can be traced to production and to locations within an entity, and how the performance of those units can be appraised. It starts by defining responsibility accounting. That's how we are going to start the lecture. However, I just want to pinpoint something here about this statement, which says that the lecture is intended to discuss the concept of responsibility centers and looks at the at how costs can be traced to production and locations within an entity. If you still remember, we talked about cost classification some time ago when we were studying, when we were in the initial stages of this module, okay, where we discussed about cost classification. And we said that there are so many ways of classifying costs. We can classify them by nature, we can classify them by location, we can also classify them by function, okay, or by in terms of their variability. Some are variable, others are fixed, or something like that. Okay, so this is the same concept we are going to pursue here. Okay, although we are not much linked to cost classification, we are actually linked to the areas of responsibility, because sometimes costs are also classified by responsibility. And this is what we want to do. Okay, we want to pursue that area much more deep. Okay, so what is responsibility accounting? This is a system of accounting that segregates revenue and cost into areas of personal responsibility in order to monitor and assess the performance of each part of an organization. Okay, it is actually very difficult to measure the performance of the whole, the performance of managers within a whole-wide organization. But we need to segment them. We need to actually give some demarcation of responsibility to a particular manager, so that whatever happens to that area of responsibility, a particular person should be accountable, should be responsible for anything that happens there. So that's the idea of responsibility accounting. We have got this big organization, but we just have to dissect some areas of responsibility, okay, so that somebody is responsible for a particular portion. Let's say these are our divisions A, B, C, D, E, and F. Okay, we've got 6 divisions there. So C, whatever happens in C should not be blamed on D. Okay, because D has no control over C. All right, so these could be, these A, B, C, D to F could be some line managers. Okay, so the idea of responsibility accounting is just that we need to segment so that we can see, we can assess the performance of each area of the organization. But we also need to have a recap of what a cost unit is. This often confuses students. Okay, they are confused when they are asked in the exam, what is a cost unit? Some people end up saying it is the cost of 1 unit. The cost of 1 unit of product. That's not it. A cost unit is not a unit cost or cost of 1 unit of product or item. That's not the definition. But the definition is, it is a unit of product or a service to which costs can be related. So you can see that it is actually a product. Okay, it is actually a product. 1 item of a product. That's a cost unit. All right. So it is a unit of a product or a service to which costs can be related. All right. So if you still remember when we tackled the areas of batch costing, we were saying that a batch is actually a cost unit. Okay, a batch of 1,000 shoes or a batch of bags which have been manufactured, or a batch of lotion jars or lotion jugs, that's a cost unit. All right. To a baker of bread, a cost unit could be a dozen of loaves. A dozen of loaves, that's a cost unit. So it depends. So for example, for a manufacturer of laptop computers, a cost unit would be a laptop. For a bus company, a cost unit could be a bus journey. It is important to be able to identify cost units, to be able to work out the cost of providing that product or service, work out the resources needed, material, labor, and other expenses to make or supply the units. So, for example, when we are talking of the baker, there is actually need to understand how much flour is needed to produce 1 dozen of bread. How much in terms of flour quantities, how many kgs, flour, yeast. Okay, there is this yeast, there is sugar. That is to be, and also some quantities of water we need to know, and also labor, electricity, all those things. So we need to know a cost unit so that we can plan we can play our cards well, or we can just plan or do our budget. appropriately. So we need also to be able to decide on the selling price. To decide on the selling price that will allow a profit to be made. In a non-profit organization, we need information about the cost unit to plan on how or where to spend the available resources. Also, to control the use of resources by comparing actual to budgeted costs. So this is why we need the information of a cost unit. Remember, this chapter is dedicated for your revision as your first step into your revision, because after this last chapter we will be doing revision and revision for the month, for the next month, the whole of next month. Okay, so what is a responsibility center? A responsibility center is a function or department of an organization that is headed by a manager who has direct responsibility for its performance. So this actually draws us back to the issue of responsibility accounting. Responsibility accounting can only be done in the pursuance of responsibility centers. Okay, once responsibility centers have been established, then we can then do our responsibility accounting. So responsibility centers are usually divided into different categories, but for the purpose of our management information syllabus, that is the MA1, the ACCA MA1 syllabus, we are only going to look at 3 such responsibility centers: the cost center, profit center, and investment center. A cost center is a place to which costs can be traced or segregated. So this one is just a center for cost. A cost center could be a subsidiary company, division, department, team, person, production line, or machine. The head of a cost center will be responsible for costs only. Is just responsible for incurring costs, not revenue, not profit. So you can't actually blame a cost center manager for the loss of profit or for the loss of revenue, because that's not his area of responsibility. Examples of cost centers can include the IT department in a company. This department does not bring any money into the firm. They are only there to incur costs. The quality control department. This again has no any interface with the customers. So they are not going to be blamed for the lack of revenue. The accounting department. These guys, they do their number crunching in their offices, but they are not going to bring any money to the firm. The manufacturing facility itself, the factory, is actually a cost center because it does not bring any money. It does not do any function related to the selling of the product. That's a prerogative of another section called the marketing section or the sales department, the sales team. Now, let's talk of the profit center. A profit center is a place where both costs and revenues are identified. So this section incurs costs, okay, but also it sells products. All right, so it accounts for costs as well as revenues. As in the cost center situation, a profit center could be a subsidiary, a division, department, team, person, production line, project, or machine. The difference is that here, in addition to being responsible for costs, the head of a profit center will also be responsible for revenues. The revenues could be sales to the outside organizations or customers, or they could be internal sales to elsewhere in the organization. For example, an IT department could be turned from a cost center into a profit center if it were to be allowed to charge IT users for the services supplied. Being head of a profit center is usually more interesting and demanding than just being the head of a cost center. So you can see that in terms of responsibility, the profit center manager is actually above, okay, is a bit superior. All right. Many people don't get the great satisfaction from ensuring that costs do not exceed budget, a cost center manager's responsibility, but would get satisfaction from beating a profit budget, a profit center manager's responsibility. Now, investment centers. An investment center is a place where costs, revenues, and capital investment are identified. Because costs, revenue, and capital expenditure all have to be identified separately, an investment center would normally be a subsidiary company or a division. Okay, because this company would have, most of it would have some piece of autonomy. They can decide on what costs to incur, what profit to do or to make, as well as what capital investments can we do. So the head of an investment center will be responsible for costs, revenues, and capital expenditure. In effect, that person has responsibility for all financial aspects of the investment center. So technically, an investment center manager is actually superior of all the three. So that is the background, but let us now talk of how to measure performance of these guys. How do we measure their performance? We have already singled out that there is a cost center manager, there is a profit center manager, and an investment center manager. All these guys have to be managed for performance. We need to assess how they have been playing their cards throughout the financial year. Okay? So the performance of responsibility centers has to be monitored to judge how both the centers are performing economically and how their managers are performing as managers. So you need to assess the performance of the center itself as well as their manager. It is important not to judge managers for elements of performance for which they have no responsibility. Like I have already indicated, we can't actually judge Division A's performance based on Division B or Division D, because Division A has no control of what is happening in Division D or Division E. So, performance measures for cost centers to start with. These include cost budgeted cost compared to the budget. For example, have we incurred costs within the set threshold? Okay, or have we reached the quantities, or have we produced the quantities according to the production budget? Then, our cost per unit. Have we incurred the cost per unit which is according to our plan or expectation. How much cost per unit have we incurred in September? Is the cost per unit we incurred in September lower or higher than the cost incurred in September last year? Then we talk of efficiency, capacity utilization, and production volume ratios. These are also used to judge the performance of a cost center. Now let us tackle each of them separately. Cost compared to budget. Cost centers will usually have budgets to work to do this cost centers will usually have budgets and to work this is actually a typo, okay, but simply we are saying the costs have to be compared. This here we are making comparisons of costs actually incurred versus budgeted costs to see if we have incurred outside the budget or within the budget. However, it says this type of comparison says nothing about what the cost center has achieved. It only tells us that the total cost of the department has been within this much, but it doesn't tell us how much have we produced within that cost which we have incurred. So much more measures have to be considered to come up with a more informed decision. Now, the cost per unit. Since a cost center manager is responsible for cost per unit produced or supplied is an obvious measure. A simple way to calculate this is to divide the costs incurred in a period by the units produced in that period. To see, let's say last year we produced 100 units at $1,000. That is last year, okay? Last year. So the cost per unit was $1,000 over 100 units, and this means that it was $10 per unit. That was the cost per unit. Now this year we again produced 100 units, but at 1,250. So the cost per unit becomes 1,250 or over 100. So this means this year our cost per unit has become $12.50. So that's how we can then assess the manager, or to put into account to say how come the cost per unit has increased, what are the reasons. He might then justify the reasons, alleging that the raw materials have been so large, there have been problems with the COVID, there are so many reasons he might give up, but we need to ensure they are based on tangible, solid evidence. Now let's go to a more mature level area now of efficiency, capacity utilization, and production volume ratio. These relate to the use of time and hence labor costs in the cost center. All right, so far the cost per unit was actually a good idea. It gives us some, it gives us some idea of what is actually going on. Okay, but it doesn't tell us much about the nitty-gritties of the production environment itself. So here, when we go to these efficiency, capacity utilization, and production volume ratio, we are now being brought into the actual manufacturing environment to see how the processes are occurring and how time is being managed in our processes. So when setting a budget for a cost center, it is normal to specify how long it should take to produce each item, that is the standard hours per unit, excuse me, and how many hours the factory is expected to work. For example, if each unit should take 2 hours to make and output is planned to be 5,000 units in a period, then the planned factory hours will be 10,000 hours. That's the budgeted hours. These will become our budgeted hours. Why? Because we have budgeted that every unit should take 2 hours to make or to produce. However, the actual production the planned production is 5,000. So therefore, the planned factory hours should be 10,000 hours. Here 10,000 is said to be the capacity of the factory, the hours it was expected to work. A number of things can happen to these plans. Although we have budgeted that we are going to use we're going to produce 5,000 units in 10,000 hours. So many things might happen which might cause that plan to change. So producing the units might not take the standard hours per unit. This will give an assessment of efficiency. All right. So if we fail to make 5,000 units within 10,000 hours, then this has to do with the efficiency. Sometimes we make 5,000 units in less than 10,000 hours. Then our efficiency would be so much high. Okay? But if we make 5,000 units outside the 10,000 hour budget, then our efficiency will be lagging behind. So more or fewer hours might be worked in the factory than originally expected. This will give an assessment of capacity. So when we produce 5,000 units in more hours, okay, in more hours, then something could also be linked to the issue to do with capacity. Okay, when we take more hours or fewer hours in the factory, then the issue to do with capacity have arisen. Then more or fewer hours might be produced, more or fewer units might be produced than budgeted. So this will give an assessment of the production volume. Okay, let's go through this example to illustrate the point. You are given the following information about Delta Beverages Kwekwe Sorghum beer plant. There is standard hours per unit, that is 2, okay, or 2 hours. Then planned production is equal to 5,000 units. Okay, actual production is equal to 5,200 units. Actual hours spent is equal to 10,800. Now, we are required to calculate the efficiency, capacity utilization, and production volume ratios. So let us start with the efficiency ratio. Efficiency ratio. Okay, this one is given by standard hours for production achieved or actual production. Okay, for actual production. Okay, divided by the actual hours. Actual hours for that production multiplied by 100. Okay, remember this is in percentage form. Okay, these ratios are presented in percentage form. So this is why we are saying you have to multiply by 100 so that you get your percentage. All right, so we know that the standard hour per unit is 2, but the actual production was 5,200. So the standard hours for actual production was 2 hours multiplied by 5,200 units, okay, over the actual hours which were taken, okay, and these are 10,800, all multiplied by 100. So 2 hours minus 2 hours multiplied by 5,200, that's 10,400. Divided by 10,800 multiplied by 100, and then you have to get your 96% as your efficiency ratio. Okay, that's your efficiency ratio. But a question might say, what does that ratio mean? Obviously, by looking at the figures themselves, you should be able to judge if the ratio suggests that we have been efficient or inefficient. Okay, let us go back to our budget or to the information there. All right, the standard hours for 5,000 units, okay, were 10,400. That is 5,200 units multiplied by 2, which we did. Which we did compute, and we obtained. We obtained 10,400. That's the budget. Okay, these were the budgeted hours, which means 5,200 units were supposed to have taken 10,400 hours. However, they took 10,800 hours, as you can see here. That's the actual hours spent. So, were we efficient or not? Remember, we were supposed to have taken just 10,400 hours, but we ended up taking 10,800 hours. That we were not efficient. So, this means we were not efficient. This is why the ratio or the percentage is below 100%. This is why it is below 100%. The ideal percentage should be above 100%, obviously. Okay, let's calculate the capacity utilization ratio. Okay, capacity utilization ratio. This one is given by actual hours worked. Actual hours worked. Okay, actual hours worked divided by budgeted hours. And the actual hours worked from the question, the actual hours worked were 10,800. Okay, the actual hours worked were 10,800. So 10,800 hours. Okay. However, the budgeted hours were how much? The budgeted hours are not these ones, ladies and gentlemen. These are not going to be obtained by 5,200 multiplied by 2. That's not the budgeted hours. The budgeted hours, according to the plan, is the original budget undiluted of any actual things. Okay, the original budget. The original budget, ladies and gentlemen, was this one. Original production plan. Okay, so the original budget was, we were supposed to produce 5,000 units at $2 per unit. I mean it's in 2 hours, rather, not 8, but in 2 hours. 5,000 units in 2 hours, which means our original budget was 10,000 hours. Okay, 5,000 units multiplied by 2 hours. So the original budget was 10,000 hours. Okay, this is our original budget. So the budgeted hours should be 10,000 hours, or multiplied by 100, and we should get so we should have something like that. Okay, we should be having something like that. How come my zeros? Okay, there is actually another 0 that is going to be crossed there. Okay, so our percentage should be 108%. So in terms of capacity utilization, what does that mean? In terms of capacity utilization, what does that percentage 108% mean? Okay, so this means that let me just try to change my pen color. Okay, let me just try to change my pen color. This means that in terms of the utilization of factory hours, more work has been squeezed out of the factory than expected. Thus, in terms of labor hours, or in terms of the labor, thus the labor force was 8%, outstretched. Okay, outstretched, or simply worked 8% more than budgeted. Okay, so more work has been squeezed out of the factory than expected. So, in other words, when we see this type of ratio, we then have to expect to see more quantities being produced. it might be a worrying situation when we see in terms of number of hours worked vis-a-vis the production quantities, there is no some justification, then it becomes a problem. Okay, it becomes a problem if the number of quantities we are going to see are actually below the budget, then it is going to be a worry. So this leads us to the next ratio, which is also pertinent. The next ratio, which is also pertinent, that is the production volume ratio. So let us do the production volume ratio. Production, let's give no space. Okay, production volume ratio. Okay. Now, this one says the ratio is equal to, the formula for the ratio. This one is actual production. Actual production. We need to know this. Actual production divided by planned production. Okay. Now, the actual production was from the question, the actual production was 5,200 units. Okay, 5,200 units. And the planned production was 5,000 units. Multiply by 100. And this should give us how much? 104. So that's 104%. So this means that production has been higher than expected. Okay, actual production has been higher than expected. And if you are analyzing all the ratios given, especially the capacity utilization and the production volume ratio, you can see that this ratio was actually telling us that something, the factory was actually squeezed out. Okay, more hours were worked. So we expected to see more production, and we are happy the production volume ratio is actually showing some 104%, which is, we exceeded the budget by 4%. We exceeded the production volume budget by 4%, which is something good for us. Okay, that's how you should go about interpreting these ratios and so forth. Let us move to the profit center performance measures. For the profit center, we are going to have the profit compared to budget. Okay, profit centers, we usually have budgets to work to, so that a simple comparison is going to be made. All right. So there is a comparison of the profit this year vis-a-vis the budget. Then the profit per unit, as we did in the cost per unit, to understand how much each unit has made in terms of profit, or how much profit have we made per each unit. Then we need to calculate the gross profit percentage, the net profit percentage, and to make some comparison between the expenses incurred and the sales made. Let us have a go to this example. You can pause the video and do the example on your own, and then continue with the video to see if you have done it right. Now we are given the information about the sales, the cost of sales, gross profit, expenses, and net profit. All right. Now we are being asked to compute the gross profit and net profit percentages, and then make a comparison of expenses to sales in percentage terms. So this is actually very easy. Gross profit percentage is equal to the gross profit itself divided by the sales. So that's 1 million divided by 1.8 million multiplied by 100. Remember, it's a percentage, so you need to multiply by 100 and you get your 55.6%. You have to do this, using your calculator to make sure the figures are okay. If they are different, please comment on the comment section to this video or email the tutor direct to the supplied email. Okay. What about the net profit percentage? Remember, the net profit is this one. So it's just the net profit divided by the sales figure. So that's net profit percentage is equal to 680,000 over 1.8 million. This, remember, you have to multiply by 100. Okay. So this should give you 37.9%. Are you going to be a happy person or not? Obviously, you're going to be a happy person because it's a positive percentage. There is some profit being made. Although there should be some target net profit percentage to compare to. Okay, so you need to have some, either using the current budget, we're budgeting to have a net profit percentage of say 20% per unit. If we have a 37.9%, we should be happy. Okay, but sometimes we also need to consider certain issues. For example, we would have misclassified certain expenses, okay, which should have been accounted for elsewhere, or we could have incorporated capital expenditure in those expenses. That's again an issue of misclassification of items of expenditure and capital expenditure, or items of revenue expenditure and capital expenditure, all those things. All right, they could have some bearing. So, but if everything is actually above board and everything is just up to scratch, then you should be happy. The other thing I have to point out, the net profit percentage or gross profit percentage could be asked as gross profit margin. Gross profit margin is just the same thing as gross profit percentage. Okay, net profit margin is just the same thing as net profit percentage. Do not be confused there with those terminologies. All right. What about the comparison to of expenses to sales? Okay, expenses to sales, comparison, expenses to sales, comparison is just an issue of picking the expenses figure, this one. How much was the figure? 320,000. So 320,000 over sales 1.8 million multiplied by 100, and this should lead you to 17.8%. Here again, it all depends on our budget. But we do not expect to have more expenses rising and rising and rising, because they would be eating on our profit. But at the same time, if we see the expense going down whilst the sales figure is going up, we should be concerned, because certain sales are driven by certain expenses. For example, distribution expense would have to rise as well as the sales revenue, because there will be more deliveries being made to customers. So therefore, we should expect to see expenses rising in the same trend. But at the same time, this is how you have to do your comparison. What about the performance measures linked to the investment center? There are two main performance measures. Please, for all the reading, you can just use your handout to read. We do not have much time to spend reading. Now, I just want to explain how you should have to go about with the relevant calculations concerned. So, there is the ROCE as well as the residual income. These are the two main ratios you need to compute when it comes to investment centers. What is the return on capital employed? This is a measure to compare the profits earned by the investment center to the capital invested in the investment center. All right, so return on capital employed is also known as return on investment. All right, return on capital employed is rather like an interest rate. Capital is invested in a bank account and income is then received. What about residual income? This measure makes a notional charge to the investment center for its use of capital. It takes the view that head of supplies divisions with capital, and that capital is to be paid for. The residual income is what is left if the division had to pay for its use of capital. So an amount of capital employed multiplied by interest rate is deducted from the division's profits. This is what happens when we talk of residual income. Now, let us go through some example. We are given the net profit of 680,000, capital employed by the division of 4 million. The interest rate 6%. What is the return on capital employed? Now, we know that return on capital employed is equal to the net profit, okay? The net profit over the capital employed. So multiply by 100. So this becomes 680,000 divided by 4 million. Multiply by 100 and we get our 17%. But how do we then have to calculate the residual income? For residual income, we then have to say the net profit, okay? Net profit X, okay? For the residual income, we've got net profit X, okay? And then we have got the less notional capital cost, which is also going to be an X, and you get your residual income. So let us use that template to determine our RA. In this case, the residual income should be the net profit is how much? The net profit, that's 680,000 notional capital cost. Notional capital cost is how much? The interest rate multiplied by the capital employed. Okay, 6% multiplied by the capital employed of 4 million. Let us use our calculators. 6% That's 0.06 multiplied by 4 million. My calculator is misbehaving. Okay, so we have got 240,000. So this one is negative. Remember, we are lessening. This is less notional cost or imputed cost. Okay, so that's how much do we get? 0, 0, 0, 0, 4. That's a 4. So our residual income should be 440,000. This is the amount the subsidiary is going to be left with, or the division is going to be left with after paying out, after paying the financier or the head office. Okay, remember the head office is going to take this money. That's their cost. That's their money. Okay, they would have invested in the subsidiary, so they have to get their money back. So this is the amount that is going to be left in the coffers of the subsidiary. This is why it is called residual income, the leftovers. Okay, so if the residual income is positive, we are going to say the investment center manager is actually working. Otherwise, we are not going to be happy. Now, the other measurement we need to consider when it comes to investment centers is what is called the asset turnover. Okay, the asset turnover measures how efficiently the assets of the business are being used. It is a measure of how well the assets of a business are being used to generate sales. It is calculated as sales over capital employed. Okay, let us continue. So that's the formula for the asset turnover. Now I think we need to look at some example. There. All right. Suppose that two companies both have capital employed of 100,000. However, company A has sales revenue for the year of 150,000 and company B has sales revenue for the year of 250,000. The asset turnover figure shows how much revenue is being earned for every dollar of capital employed. So for the above information, or for the above companies, the asset turnover ratios should be, for both these companies, company A and B. All right. For A, let's say for A, company A, this should be the sales revenue for company A was 150, so that's 150 divided by the capital employed. All these companies, both the companies, they've got their capital employed of 100,000, so we are going to use the 100,000 here, multiplied by. Now we need to be very careful for the asset turnover. We are not going to say multiply by anything, because this should be an absolute figure. So it should be an absolute figure. Okay. A turnover is measured in times. Okay, it should be like in times. So you can see that here we are having an asset turnover of 1.5. What about for B, company B? The sales figure was 250,000, all divided by 100,000. So we are going to have the asset turnover of 2.5. But what does this show? Or what does this tell us? This shows that common B is earning $2.50 of sales revenue for every dollar invested. Compared to only $1.50. Compared to only $1.50 of sales revenue for common A. That's what it tells us. Okay, so it is actually very effective to such companies which have got many subsidiaries. Let's say the holding company, a holding company or parent company is this one. It has got subsidiary A, subsidiary B, subsidiary C. So when they give these subsidiaries investment capital, they might give the same investment capital. So they need to know if those subsidiaries are paying back or are improving in their performance. So the asset turnover is actually a good measure for that, where they will see how much dollar are they making from the investment they have incurred. Okay, that is it. Those are other issues to do with the asset turnover. You may actually read through, and I hope you have been helped with this presentation. If you feel you need more coaching, please don't hesitate to contact me on these numbers, 263-774-596-368, or just send your email request on that email. All right, and feel free to visit our website at www.transcalconsulting.co.zw. Until then, may the good Lord continue to bless you forever and ever. Amen.